When we're talking about accounting for merchandise companies, one of the things that we have to remember with merchandise companies is that the way they generate revenues is by selling merchandise inventory to its customers. They acquire their merchandise from other merchandise companies or other manufacturers, and in turn, they take the product and then they resell it to their customers. Now, as your inventory purchase for resale, you can either be buying your inventory either on a wholesale basis, where the plan is typically that you're going to buy in bulk and then in turn sell that inventory to retailers. But that's kind of changed in some extent nowadays in today's market, where you have wholesale warehouses who are now selling to the end user. So basically, what some companies are now doing is that they're both the wholesaler and the retailer. The retailer normally is a smaller business or a company. It doesn't necessarily have to be a small business that buys product from a wholesaler, breaks up the larger quantities into smaller quantities so that they can sell to the end user customer. Now, the thing with inventory is now, since we have a sale of inventory and we can determine how much it costs to purchase and to get that inventory in a saleable condition, we can now take a look at that inventory and compare it to the sales. Remember, we were talking back in other chapters where we were talking about the matching principle, where we said we want to match the expenses in relationship to the corresponding sale that generated that expense. So now what we're doing here is that when we take a look at here, we could determine the profit on the sale of the inventory by comparing the net sales minus the cost of goods sold, which is the cost of the inventory that's sold to the customer, and we get this new concept called gross profit. Now, some textbooks will call gross profit a different term called gross margin, but essentially they're the same thing. Now, let's break this down real quick in terms of what is net sales. Net sales is the gross sale minus sales, returns, and allowances, which are the sales that come back to us from our customers either for whatever reason, where a customer doesn't like the product, it's damaged, or it's just not the right product in general, and they return it to us, and they also return the inventory. So we have to reverse the sale and also reverse the reduction of our inventory because we're bringing the inventory back. The other reduction of gross sales to get net sales is what we call sales discounts. Now, what a sales discount is our incentive to our customers for them to pay our invoices early. Now, if you're looking from the perspective of a sale to an end user customer, such as like you or I, most of the times those transactions are made by cash. But in today's business environment where you're doing business with other businesses, doing businesses with those other businesses, a lot of times we have to extend credit, otherwise what we call accounts receivable, to those customers, and then they pay us at a later date. The reason we do that is because then they'll buy more product from us, and also because it helps them and also helps us to understand how we manage our cash flow. Now, because we are not in the business of extending credit, we're not a bank, we're not a finance company, what we would rather do is when we sell stuff to our customers is that they pay us quicker than when we ask them to pay us back. We use the terms before where we put in a term such as 2/10 net 30, which is read 210 net 30. Now 210 net 30 means this invoice is due in 30 days, the net invoice. However, if you pay within 10 days of the date of the invoice, we'll allow you to take a 2% discount. Now, we talked about this in the online lecture. So, all we're saying is that this is the invoice terms. If we pay within the invoice terms, which we have provided to our customers, we have to give them this sales discount. This is the exact same discount that we've talked about in other chapters where we talk about purchase discounts when we buy from our vendors and we pay our invoices early. So if I take my gross sale minus my sales returns and allowances minus my sales discounts, that'll give me my net sales. So net sales is pretty straightforward to figure out. Once again, gross sales minus sales returns and allowances minus sales discounts. Now, cost of goods sold has its own calculation. Now, when we calculate cost of goods sold, what we're looking for are the costs or the corresponding expenses to these sales. Those corresponding expenses are the inventory that we purchased. So what we have to do is determine which inventory that we've sold and at what cost. Now, there's two methods of keeping track of our inventory. One is called the perpetual method, and the other is called the periodic method. Most businesses today use the perpetual method. And the reason why they do the perpetual method is because of technology, providing information, because perpetual, basically, we update our inventory records at the time of the sale and also when we purchase product from our vendors. So we know exactly what we have in our warehouse or on our showroom floor at any given time. Prior to the automation of our accounting records, many businesses used the periodic inventory method. And the periodic inventory method was more convenient because we didn't have to keep track of our inventory on a day-to-day basis, at least from an accounting perspective. What we rather have done is that what we do is we keep track of our inventory for the period. So we start with our beginning inventory balance, and then we add in our net purchases. Now the question then is, what is net purchase? Net purchases are our purchase at cost, what it cost us, plus our insurance that we might pay for the transit, plus customs duties, plus, let's see, freight in. And notice I saying freight in. What we mean is the freight charges or the delivery charges that we're paying for to get the inventory delivered to us, to our location. That is part of the cost of the inventory. When we pay, if you've seen an eBay where it says no shipping costs, well, someone has to pay for the shipping costs. So if we pay for the shipping costs when it's coming from our vendor, then that shipping cost is part of the product. If we're paying for the shipping cost to our customer as part of the sale, the freight out, once again, the freight out is a selling cost. It's not an inventory cost. Okay? Plus any other cost to get the product saleable. Okay? So net purchases is the purchase price at cost plus the insurance, custom duties, freight in, any other costs. Now we do subtract a couple things out of here, minus our purchase discounts. And we, just like we have sales discounts, this is our purchase discounts when we pay our vendors early, minus purchase returns and allowances. Okay? So all these items here come into what we call net purchases. When we add in our beginning inventory plus our net purchases, we get this concept or this item called merchandise available for sale. Basically, what this is saying is all the inventory that we started with, plus all the inventory we purchased for the period, that's all the stuff that we have available to sell to our customers at the end throughout our period. Now, when we know how much merchandise is available for sale, it's going to only two things can happen with that inventory. Either we sell it or we keep it at the end of the period to be moved over into the next period. So in other words, they'll either be sold as cost of goods sold or they'll remain in inventory as our ending inventory balance. So when we take our merchandise inventory available for sale minus our ending inventory, we get cost of goods sold. The reason why we structure this equation this way is because in many cases we know what our merchandise available for sale is because we've kind of collected all that information. We've collected that information because we knew what we started with, we know what we purchased, and then because we don't have a complicated accounting system to keep track of our inventory, we need to go out and count that inventory at the end of every period to identify exactly what we have in ending inventory. Once we know exactly what we have in ending inventory, we can subtract that out, because that's what's left over, to give us our cost of goods sold, is what we sold. Now remember, in the next period, this ending inventory balance will become the beginning inventory balance in the next period. So this is one of those permanent accounts that ends up moving from ending balance becomes the beginning balance in the following period. Now, one of the things that now that we have additional information, we can change the format of our income statement. In that now we can change the format of our income statement to what we call as a multi-step income statement. And in a multi-step income statement, we can take our gross sales minus our sales discounts minus our sales returns and allowances to give us our net sales. Very similar to what we just showed you on the above screen. Now what we're doing is we take our gross sales, subtract out discounts and the returns and allowances to give us our net sales. Next, we subtract out our cost of goods sold, and that'll give us our gross profit. This cost of goods sold calculation, if we're using the periodic inventory method, would be the merchandise available for sale minus our ending inventory. Then we take into account our operating expenses, and I just gave you a simple or basic list of some of the items that might be considered operating expenses. Subtract that out, and then we come in and we have our net income. Notice that this multi-step income statement provides additional information than the single-step income statement that we've talked in previous chapters. In previous chapters, that single-step income statement, we grouped all the revenues into one category, and then we grouped all the expenses in another category. Ultimately, between the single-step and multi-step income statements, the net income number would be the same. It's just how we're representing the information to the end user who is reading our financial statements. So at this point, let's move on to some of our problems. Now let's take a look at exercise 4-2, where we're going to take a look at a sales transaction from both the seller side as well as the buyer side. The problem reads, Santa Fe Company purchases merchandise for resale from Mesa Company with an invoice price of $24,000 and credit terms of $310 net $60. The merchandise has a cost to Mesa of $16,000. Santa Fe paid the discount period, assume that both buyer and seller use the perpetual inventory system. Now there's a couple things here that stand out in just this one paragraph here. One, first of all, you have to figure out who the buyer is and who the seller is. It says Santa Fe purchased, so therefore Santa Fe is the buyer. Mesa is the seller. The agreed upon sales price between the two companies is $24,000 and it's on credit terms, so cash doesn't change hands. And the terms are 310 net 60. So in other words, the invoice is due in 60 days from the date of the invoice, but if Santa Fe pays within 10 days, Mesa will allow Santa Fe to pay the invoice with a discount of 3% on that invoice. Now we have to keep track of the cost that Mesa incurs that corresponds to the revenue that they generated of this $24,000. Mesa's cost was $16,000. Now, the reason why this is important is that if they were using a periodic inventory system, we would not recognize the cost of goods sold, the $16,000, until the end of the period. But because they're using a perpetual inventory system, we have to follow the matching principle and we have to recognize the expenses at the time of the sale. So whenever you see perpetual inventory system, we have to make sure that we do the cost of goods sold journal entry to recognize the expense and the reduction of the merchandise inventory because we've sold that inventory and it is no longer our inventory. So for requirement 1, it says prepare the entries that the buyer should record for the purchase and the cash payment. So the buyer is Santa Fe, so what we have to do is record the journal entry for Santa Fe. So when Santa Fe buys the inventory, and remember it's for resale, they're going to debit the asset account called merchandise inventory. Now this merchandise inventory is an asset account, and we're going to record it at what our cost is or Santa Fe's cost is, which is $24,000. Now, Santa Fe did not pay cash for it, so what Santa Fe did is that they bought it on terms from Mesa. So when it's on terms, they promised to pay, so the accounts payable account is used to recognize that there's an amount due to the seller. So this is all that has to be recorded from the buyer's perspective. From the buyer's perspective here, they increase the merchandise inventory account, but we also increase the liability account showing that Santa Fe owes Mesa money. Now I'm going to jump over here to requirement 2 because requirement 2 says we need to recognize the transaction for the seller side. So I just kind of want to show you what the difference is between the two. On the seller side, first of all, we have to recognize the sale. So because this is on credit and no cash has changed hands, we need to recognize that our customer owes us money. So we're going to increase an asset account called accounts receivable. And remember we talked about in the past that accounts receivable means that someone owes your company money. The corresponding side to that is that we also incurred a sale. So we're going to go ahead and recognize the sale. And in both cases, the amount is $24,000, which is the amount that we agreed upon with Santa Fe. Now, because we're doing a perpetual inventory says that we have to recognize the cost of goods sold at the same time. So at the same time, what we're going to do is recognize the cost of goods sold entry, or the expense. So we're going to debit the expense account called cost of goods sold. And we're going to debit that for the cost of the inventory, which was $16,000. So we're going to put $16,000 as a debit. But because we used up our inventory, or we sold our inventory, we have to reduce the merchandise inventory account by the $16,000 as well. Okay, so that's the journal entry the seller has to make. The seller has to recognize the sale, but they also have to recognize the corresponding expense. Now, what about at the time of the payment? Now, it says here that Santa Fe paid within the discount period. In other words, this accounts payable that Santa Fe pays they didn't have to pay the entire amount because they paid within the 10-day, the 3%, 3% if we pay within the 10 days. So what we need to figure out is first, how much cash did they pay? So if we go up here, and I'm just going to do the calculation right now, the invoice price was $24,000. Then when we say less the discount, and the discount was 3%. So we can put a formula here and say take the invoice amount times 3%. We're going to get a $720 discount. So the required payment will be the difference, which is the $24,000 minus the $720. So we're going to pay $23,280 in cash. So Santa Fe is going to pay cash of $23,280. So when Santa Fe makes that payment and they take the discount, they're no longer going to owe that accounts payable. So since we increase the liability with a credit, we're going to decrease the liability with a debit. So we're going to debit accounts payable for $24,000 because we're going to make that payment and we no longer owe that bill. Now, how much cash did we pay? Well, we showed up here that we're going to pay $23,280. So we're going to reduce our cash account by $23,280. Now, our journal entry is out of balance by the $720 discount that we took. So, what account should we be crediting? If we were going to use the periodic method, we would have an account called purchase discounts. But because we're using the perpetual inventory system, we want to recognize the change in the price that we paid for that inventory right away. So what we're going to do is reduce merchandise inventory by the $720. Now, once again, let me say that one more time. If we were using the periodic inventory system, the other inventory system that we talked about, where we update our inventory at the end of the period, this $720 discount would be posted to an account called purchase discounts. And at the end of the period, it would update the inventory balance. But because we're using the perpetual inventory system, which means we need to recognize the movement of inventory from a cost standpoint as soon as that occurs, we need to reduce the merchandise inventory as soon as we make this payment to reflect that our cost of our inventory is not really $24,000, but really our inventory price is $23,280. We originally recorded the merchandise inventory on our balance sheet for $24,000, so we need to make an adjustment here to reduce it by $720. So this is what we would have to do as a journal entry to recognize that we paid the bill and took advantage of that 3% discount because we paid within the 10 days. Now, let's take a look at what happens to Mesa. Mesa receives cash. So we're going to debit cash. And once again, how much cash did they receive? Well, they received our payment of $23,280. So that's going to increase the cash account by $23,280. Now, the accounts receivable that we originally recorded was $24,000, but we only received $23,280. So we need to recognize in our contra revenue account called sales discounts the $720. Now remember what a contra revenue account was? A contra revenue account is an account that sits on the income statement on the income side of our chart of accounts, but its normal balance, instead of being a credit balance like all the other revenue accounts, the normal balance is a debit. And remember, the normal balance of an account is the side of the T account that increases the value. So when we do a debit of $720, we're increasing this contra revenue account by $720, which is going to offset our sales number that we have over here. So now that we have recognized the cash, we've increased our sales discount account. Now we have to recognize that we no longer have an accounts receivable with Santa Fe. So we have to reduce our accounts receivable by the $24,000. And that's the journal entry you'd have to make. Now the last requirement here says assume the buyer borrowed enough cash to pay the balance on the last day of the discount period. In other words, Santa Fe wants to take this 3% discount. So on the 10th day, they go and borrow the money from whatever their source is, a bank, a finance company, or even an investor. They promise to pay 8% interest. Now notice this is an annual interest rate, not the interest for the period of time. They're going to pay it back on the last day of the credit period. In other words, they're going to pay it back after the 60th day. It says, compute how much the buyer has saved by taking this discount strategy. Is it really worth to take the 3% discount, and even if we have to borrow the money at 8% interest on an annual basis? So what we need to do is make the calculation. And what we want to do here is let's ask the question, how much money do we have to borrow? So how much do we have to borrow? Well, we have to borrow the $23,280. So let's put $23,280 here. At the annual interest rate, which is 8%, so I'll put 0.08 as at 8%. If I multiply what we borrow times our annual interest rate, we'll get $1,862.40. So this would be our interest for a year. Now what we need to find out is how much would that be per day. So the interest per day, that interest per day is, let's take this amount and divide it by 365 days in a year. That'll give us $5.10, and then there's a long fraction. So let's do this. Let's round this number. Let's round this number to $5.10. So now the question then is the saving, how much did we really save? So the savings from taking the discount, and we can see how much our savings was, $720. So we're going to take $720 minus the interest paid on a 50-day loan. So what we're going to do is take our daily interest, $5.10, times 50 days. We're going to pay $255 worth of interest. So the savings minus the amount of interest we have to pay, so that this would be our net savings from borrowing to pay in the discount period. So let's take the difference between the two, 720 minus the 255, and we save $465. All right, so that's how we solve this particular problem. Let's go on to the next one. Once again, let's practice doing journal entries for recording, analyzing and recording merchandise transactions for both the buyer and the seller. So in this particular problem on May 11th, Sydney Company accepts delivery on $40,000 worth of merchandise it purchased for resale from Troy. So in other words, Sydney is our buyer, Troy is our seller. With the merchandise is an invoice dated May 11th with terms 310 net 90. In other words, the invoice, the $40,000 invoice, is due in 90 days, but if Sydney pays within 10 days, Troy will grant a 3% discount to Sydney. The goods cost Troy, the seller, $30,000. When the goods are delivered, Sydney pays the $345 to express shipping for delivery charges on the merchandise. In other words, Troy is not charging Sydney for the shipping company is. So therefore, this shipping charge is not part of the $40,000 invoice that's been sent. It's a separate payment. Okay? Then on May 12th, Sydney returns $1,400 of goods to Troy, who receives them 1 day later and restores them back to inventory. The returned goods had a cost to Troy of $800. Then on May 20th, Sydney mails a check to Troy for the amount owed. Because May 20th is within the 10-day period, because on a May 11th, so therefore if they paid before the 21st, they get the 3% discount. So Sydney's going to take the 3% discount, and it says Troy receives it the following day, so it's within the discount period. Both Sydney and Troy both use the perpetual inventory system. So now let's do the journal entries, and instead of going back and forth, we'll put them side by side, but let's first do, in chronological order, the journal entry for Sydney, the buyer. First of all, on May 11th, Sydney purchased the inventory. The inventory cost $40,000. So what we should do is increase the merchandise inventory account, which is an asset, remember? So assets go up with debits. So we're going to debit merchandise inventory for $40,000, which is the amount of the purchase, right here. Okay? But we didn't pay for it because we know it's on terms when we see the 310 net 90. So what we have instead is a liability called accounts payable, and we're going to increase the liability by $40,000. Now, on the same day, remember we said here, Sydney pays $345 to express shipping. And the assumption is if it doesn't say on terms, they paid it on cash. So what we need to do is do a journal entry that increases the merchandise inventory account by $345, and that we paid cash for that. And we're going to decrease our cash account by $345. Now, some of you might ask the question, why did we not charge to freight in here? Or why didn't we do it to freight expense? Remember, what we said is the cost of the inventory is the purchase price plus all the charges that are incurred to get it into its saleable condition, which includes the freight charges. So when we incur freight charges for receiving that inventory, that is part of the cost of the inventory. So we're going to add that back into merchandise inventory. Now it says down here is that on March on May 2nd, we return $1,400 worth of inventory. So in other words, we're going to return that inventory, so we no longer owe the money. So we're going to reduce accounts payable by $1,400. And we're going to show that the inventory went back. By $1,400. Notice here the freight, we don't get a refund for the freight. All we get the money back is what we owe Troy for giving their inventory back. So then on the 20th down here, Sydney pays Troy. Now the question is, how much does Sydney owe? If we take the purchase price, or the invoice price, which was $40,000, less the return, which was $1,400, we can figure out how much was owed, which is going to be the $40,000 minus the $1,400. So we owe $38,600. Then we want to say less the discount. And then remember, the discount was a 3% discount. So what we're going to do is we'll do it this way. Take this number times 3%. We're going to take a $1,158 discount. So the amounts to be paid will be the difference between the two to give you $37,442. So what happens here is that Sydney is going to pay out $37,442. If we pay within the discount period, Sydney is going to reduce their accounts payable by the amount that was owed, and the amount that was owed was $38,600. Now, because they don't have to pay this $1,158, which is their discount, they're going to have to reduce the value of their merchandise inventory because they know they didn't have to pay that amount when they bought this $40,000 inventory originally. So what we're going to reduce is that we're going to reduce that merchandise inventory value for the amount that we didn't have to pay. So in other words, that $1,158 is going to be reduced out of merchandise inventory. Then we have to show how much cash did we pay. So we're going to reduce our cash account by $37,442. So those are the journal entries that Sydney would have to make for this transaction. Let's take a look at what Troy would have to do. Troy, on the other hand, would have to originally recognize the sale. So they would have to debit accounts receivable, and they would debit accounts receivable for the $40,000 of the original sales transaction. They would also have to recognize the sale for the $40,000. Now remember, because they're doing the perpetual inventory method, we have to recognize the cost of goods sold at the same time of the sale. So what we're going to have to do is increase the expense account called cost of goods sold. And the cost of our sales here, as it tells us, was $30,000. So we're going to increase our expense by $30,000, and then we're going to reduce our merchandise inventory because we sold out our inventory by the $30,000. Now, remember that $345 to express shipping? We do not need to recognize the $345 because Troy did not charge that to Sydney. The shipping company did. So that $345 that Sydney had to recognize is not part of Troy's responsibility. So therefore, we're not going to make that journal entry for us because nothing happened to us. Now, on the 13th, we received that inventory back. So what we're going to have to do is we're going to have to reduce the accounts receivable by $1,400. So what we're going to do is we're going to use a contra revenue account again called sales, returns, and allowances. For $1,400. Notice we use the contra account sales, returns, and allowances rather than reducing the sales because we want to know both numbers. We want to know how much we sold, but we also want to know how much we got, what we're taking back from our customers. Because this could be a very telling number if this is a repeated incident with lots of our customers. Do we have a bad product? Are we selling things that our clients don't like? Once we start accumulating these sales returns and allowances, it's going to tell us if we have some trends or things we have to worry about. Now, on the other side is they no longer owe us any money, so we have to reduce the accounts receivable by the corresponding $1,400. Now, you'd think we're almost done, but because we did this journal entry here, where we recognize the expense at the time of the sale, so now that the sale doesn't really exist anymore and we receive the inventory back, we're going to have to recognize the merchandise came back. So we're going to increase our merchandise inventory by our cost, and they tell us here that the cost of that inventory was $800. So we're going to increase it by $800. And then what we're going to do is reverse the cost of goods sold transaction because we didn't sell it. And so we're going to reduce the expense by the $800 as well. Now, some of you might ask the question then, if this merchandise inventory is returned, why are we bringing it back? Well, because we are typically taking that inventory back. We don't know what condition that inventory is in. If it's in resaleable form, we make it available for sale again. If it's damaged, we may return it to our vendor, but in this transaction itself, we don't recognize that return yet until we actually return it to our vendor. Okay, the last entry that we need to make here is when we receive the cash. Once again, we've already calculated how much cash we're going to receive because Sydney is going to send it to us. So we're going to increase our cash account by the $37,442. We're going to increase our contra revenue account called sales discounts in the amount of the discount that Sydney's going to take, which is $1,158. And then we're going to recognize that they no longer owe us any money. So we're going to credit accounts receivable for the amount that they owe us, which is the $38,600. So those would be the journal entries you have to make for this transaction for both the buyer and the seller. All right, let's go on to the next problem. Our next problem, we're provided with an adjusted trial balance for August 31st, 2008. Now remember, this adjusted trial balance that you're looking at right here has already had all the period end adjusting journal entries applied to them. So we're not seeing those up the first 4 columns of that adjusted trial balance worksheet. All you're seeing are the numbers after they've been adjusted. And if you notice here, this isn't probably all the accounts, but the ones that we need to see for creating financial statements for this particular company. The reason why I say that, because I don't see any cash or other accounts receivable. They buried that all in the other non-inventory assets. So that's the reason why it's not a totally complete adjusted trial balance. Now, also they provide us with additional information where it says on August 31st, 2007, merchandise inventory was $25,400. In other words, this $25,400, if we're doing this for August 31st, 2008, and they're giving us this value for August 31st, 2007, this is the ending balance for the merchandise inventory for 2007. In other words, August 31st, 2007's ending balance for a permanent account is the September 31st, 2007 balance, or the beginning balance for the next year that we're doing these financial statements for. So this $25,400 is our beginning balance for the year. Supplementary records of merchandising activities for the year ended August 31st, 2008 reveal the following itemized costs. Invoice cost for merchandise purchases, purchase discounts received, purchase returns and allowances, and cost for transportation in. Remember, cost for transportation in, what is that? That's the freight charges that we've been talking about that we're paying for to get the inventory from our vendor to our warehouse. So it's the incoming freight cost, not the outgoing freight cost. Okay? So now what we have here is a couple of requirements. Requirements 1, 2, 3, and 4. I'm going to try to see if I can squeeze most of it in here. If not, we're going to have to try to make some changes. But real quick, it says compute the company's net sales for the year. Remember, what did we say net sales were? Net sales were all the sales for the company less the contra revenue accounts. So to calculate the net sales, first of all, we need to know what the sales dollar amount is. So if we go over here, we'll see that the sales dollar amount is $225,600 right here, that credit balance. Remember, sales is a revenue account, and revenue accounts, the normal balance for a revenue account is a credit. So this $225,600 is a credit balance, and we're going to stick that right here. $225,600. Okay, now we said we have to subtract out the contra revenue accounts. So we're going to say less sales discounts. And if we look at the sales discounts right here, $22,500. Remember, contra means that the normal balance is on the other side of the T account. So if sales is normal balance is a credit, the normal balance for a contra revenue account is going to be a debit. So we know that this is going to be a minus, as we say less, minus $2,250. Also, we're going to subtract out the sales returns and allowances. Oops. Sales, returns, and allowances. And if we look that number up, it's the $12,000. So the difference will be our net sales. So basically, we're going to take the $225,000 and we're going to subtract out, or we're going to add the negative numbers to get our net sales is $211,350. All right, so let's do the next one. Requirement 2 says compute the company's total cost of merchandise purchase for the year. In other words, we're asking is, what is the net purchases? What are the net purchases? So let's do this. What we know we start with the net purchases is the invoice cost for all the merchandise purchases. Remember our total purchases. So right here it says our invoice cost of merchandise purchases was $92,000. So that amount of $92,000 will go here. Less, remember we said we need to know what our net cost was. So we're going to say less our purchase discounts. And our purchase discounts, when we look here, was $2,000. And now we're also going to have returns and allowances. And that one is right there. So that's $4,500. Now the thing we need, remember we need to add in also, because remember this whole thing of net purchases are what is the cost of that inventory and what does it cost us to get it into a saleable condition. So last thing we have in here is the freight charges. So we want to add in, so we want to add the cost of transportation in, and according to that, the number is $4,600. If I add all those items up, so I'm going to take the $9,200 plus those negative numbers of $2,000 and the $4,500 and add back in the freight. We're going to get $90,100 as our net purchases. All right, so now that we've figured out our net sales, we've figured out our purchases, our net purchases. Now we can go and we can figure out the multi-step income statement and the single-step income statement. Now, I don't have a lot of room here, but one of the things we have to figure out is our cost of goods sold number. Now, we don't have all that information of it. We have that information here in between our trial balances and our purchases. So let's go ahead down here, and I'm going to make a little bit of space so we can figure out what cost of goods sold is. Okay, now remember in the cost of goods sold calculation for a periodic inventory, we said take the beginning, let me give myself some little space, take the beginning balance then we want to add in plus our net purchases. That'll give us our merchandise available for sale. Then we say minus our ending inventory. That'll give us our cost of goods sold. So that's our formula. So what we have to do here is we have to find what's the beginning balance. And according to here, it said our beginning balance is $25,400. So we're going to go ahead and put our beginning balance right here, $25,400. We know our net purchases by what we calculated out was $90,100. So $90,100. Add these two together. So our merchandise available for sale is $115,500. Then we have to find out what our ending balance was, and according to this, we go back up here. What's our ending balance? Right here, $41,000 is our ending merchandise inventory. So we know it's $41,000 is our ending balance. So our cost of goods sold is our merchandise inventory available for sale minus our ending balance. So our cost of goods cost of goods sold is $74,500. Okay, because we're going to need that number when we do our multi-step income statement. So what we're going to do our multi-step income statement, we can say now, take our net sales. Now, of course, make sure you do your titles, but because of space, I'm not going to have space to do it. So let's do net sales. And our net sales amount, as we calculated down here, was $211,350. Minus your cost of goods sold. And we calculated that out to be $74,500. That'll give us our goods, our gross profit, minus our expenses. So let's take our expenses. We're going to say our selling expenses. So go to our trial balance and let's find all our selling expenses. And our selling expense includes salaries. And that came out to $32,000. Rent. That came out to $8,000. Notice I'm just pulling these numbers over here. Supplies. And that was $1,500. Advertising. And that came out to $13,000. Okay, if I add those all up, take all those all together, I get $54,500 as my total selling expense. Okay, now let's take my general administrative. And I take my salaries. That was $28,500. My rent. And that was $3,600. Supplies of $400. So that gives me my total expenses, or my total general administrative of $32,500. Now I need a little more space, so I'm going to move this down a little. Okay, now what we're going to do here, that's my total G&A. So I'm going to put here 1, 2, 3, 4, 5, 6. Okay, now I can add up my two numbers here. So what I'm going to do is I'm going to say total expenses. And I'm going to add up the $54,500 and the $32,500. So I'm going to take the $54,500 plus the $32,500. I get $87,000 in total expenses, which then will give me my net income. And I'm going to take my gross profit number minus my total expenses to give me my net income. So I get my net income of $49,850. Now we can do this exact same thing, and we could do this as a single step income statement, which is requirement 4. So let's do a single step income statement. We could do, once again, net sales. Our net sales was $211,350 minus our expenses, and we could have said cost of goods sold, and cost of goods sold, if I look up there, is $74,500 minus my selling expenses of $54,500, my general and administrative, which is $32,500. I could have added those all up. I get $161,500. To give me my net income, which should have been my $211,350 minus the $161,500, the $49,850. Notice that the net income number is the same between the multi-step income statement and the single-step income statement. The difference is providing enough detail for the reader of the financial statements to better understand what the numbers really mean. In the single-step income statement, all we're doing is comparing our revenues with our expenses. Here in the multi-step income statement, you're seeing a lot more detail as it relates to where do those numbers come from. That these expenses are selling, these expenses are administrative, and that you have cost of goods sold, so you have more detail for someone to make good financial decisions. All right, well those are our problems for this chapter. So let's keep at it, and we'll see you at the next chapter.